Hello everyone! Today we're going to be taking a look at how you can trade one of the most popular purely speculative assets out there. We're talking about the future contract based on the price of the S&P 500 index, which you can probably see over here, even though it could be quite hard, especially if you're watching it on the small screen. But that's a whole other topic. Now look, if you're not familiar with futures at all, I'd highly recommend that you pause the video right now and take a look at another lesson we recorded for you not so long ago. I believe it was just a couple of weeks or almost a month ago now. Doesn't really matter. There we went quite deep into the whole theory, how these contracts were established, what they represent, etc., etc. In this video, we're going to be considering the more practical side of the matter. We're not even going to explain like what the S&P 500 is as such. I mean, you probably know it. It's an index, stock market index, equity index as they call them sometimes. Measures the performance of the stocks, large 500 companies as US, as established basically by a private company. That's a whole other topic. But that's all we're going to care about. We've got our asset, we've got the future contract on the S&P 500, once again, sometimes called E-mini, something to keep in mind. And let's consider the practical side, starting from how can we add this particular feature to our platform. Without further ado, let's get going. So for starters, you need to pull out your market watch if you haven't done so already. If you, for some reason, have only been considering the charts recently, what you might want to do is go into the view, market watch, pull out all the instruments that you have, go with the right mouse button, right click as I call them, and go directly into symbols. If you go over here, you're going to see a whole bunch of things on our beautiful MT5 global account. And here you're not going to be going into Forex because future contracts are not Forex. We're also not going to be going into indices because the indices that are based over here are actually CFDs, what are called contracts for differences. They are traded in a much different way through completely different channels. So this is not what we're going to be doing over here. What we want to do is go directly into the futures and go into the Globex. This is what we care about. Now we got a whole bunch of things over here, but what we care about here is not the bean futures, it's definitely not the gold futures, but what we have over here is aptly named E-mini S&P 500 index. Now, depending on when you're going to be watching them, they might have different expiration dates. Once again, if you're not sure why would an asset have an expiration date, please pause the video right now, go and take a look at the other video that we've done on the futures. You'll understand a bit more about what it's all about. So find your S&P 500 whenever you're going to be looking at it, click on it a couple of times, and it's going to be added directly to the platform. Now, in my case, I've already done that. Here it's was aptly named FUTES Z20, and that basically corresponds to the future contract of the S&P 500 with an expiration date on the December 20th. Now, we might also add another one. Let's see where we have it over here. Actually, whenever you get stuck or you just want to look it up a bit quicker, over here you got this beautiful field, type in S&P and then look for it directly over there. Now we've added it over there already. Here we have it. So this particular moment in time we've got two different future contracts, one with an expiration date on December 20th and another one with an expiration date on the March 21st. I'm going to add that one to the platform as well, just for you to consider the differences between them. You're going to be seeing quite a lot of them, especially on the lower time frames, and the reason why they're going to be different, which we'll touch on in a point, is basically one word: liquidity. Now, we've added those ones. Let me just double check these ones. We got ESZ20, which got an expiration date on December. Here we have it. And the SH21, which is the March. Beautiful. Now let's consider the contract that is going to be expiring sooner, so on December. And actually we are already looking at it. Now, just for the comparison, if you pull this one out, if you can see it quite well, we are currently looking at the minute charts. These are the 5 minutes, 15 minutes, 30 minutes, hours, and back to minutes. Now, if we drag on, if you remember how to do that, the futures with expiration date on the March 21st, well, you're going to be seeing this, which is not quite nice to look at, because instead of the usual candle patterns, etc., you see a whole bunch of basically dotted lines, which are not nice to look at, not nice to analyze. But the reason why that happens is actually pretty simple, and it's all got to do with what I mentioned before. That's what is called liquidity. Now, let's come back to our contract with expiration date in December. Let's dive deep a bit into this one. Now, what we see over here is actually quite interesting, because you might see that currently we have this nice trend line currently holding on to it. We've got another level over here, which seems to provide quite a level of resistance. And yeah, let's see what we can do. Now, before that, let me explain briefly what I meant by the liquidity. Once again, if you're not familiar with the term, quite easy to explain. This amounts basically to the amount of deals that are being conducted each and every second, each and every minute, each and every hour on the particular asset. So whenever you see an asset such as the one over here, actually, especially in the futures, you're going to be seeing it a lot. So over here we got the future contract of the S&P 500 with an expiration in December being traded with these particular tendencies, and if you pull out the March, you're going to be seeing this. Now, the reason for that is, once again, quite simple. There are a lot more people trading futures with an expiration date of December 20th, which basically come in a month and a half, than there are on March. Because being a purely speculative asset, I'm going to touch briefly on what that means. Effectively, people only want to speculate on it. They don't plan to invest. They don't plan to hedge their bets, as they could actually try to do that whenever we're talking about some contracts on the actual commodities, such as beans, perhaps gold, perhaps coffee, etc. So, being a purely speculative asset, it means that almost always the assets with nearer expiration date are going to have much more liquidity, and thus their charts are going to be much easier to analyze. And at the end of the day, that's all we care about. So I've just added the contract with expiring at the March 21st for reference, but I wouldn't effectively recommend that you trade it, especially on minutes. Because if you're considering taking some long-term position, by all means, you can consider what's going on. For example, over here you can see that the price is mostly identical on the hours, but when you go down to minutes, well, you see quite a lot of discrepancies, and these are not very nice to trade. You can believe me on that. However, if you do consider taking some positions in the medium to long term, so for example, this contract, which is expiring by definition on the December 20th, it's only going to be valid until the 20th of December. If you're planning to open some position and hold it, for example, for more than a month and a half, so for example, till January, February, then of course it will make quite a lot more sense for you to consider the contract with an expiration date on the March 21st, not December. That's just basic. Now, coming back to this, let's consider effectively some useful trend tools that we can use over here. Now, if you've been following the markets as of recently, you might have noticed that the currencies are getting quite a bit unstable. Well, that's only to be expected given what's going on with the elections in America, etc., and COVID, but that's to be expected. However, the futures, especially the ones on a speculative asset like these, are quite have always been quite nice to trade because you've got some solid levels of support, of resistance, of trend lines, which are, I wouldn't call them